Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Investors continue to struggle with two different sides of the recession debate as it pertains to the most aggressive Fed rate hike cycle we've seen since the early 1980s. In one corner, we have the bond market with treasury yield spreads screaming for a recession. In the other corner, we have the equity market pricing in virtually zero odds of a recession, citing consumer resilience tied to labor market strength. It appears as though the equity market has U.S. corporations on their side when it comes to fighting the Fed. In today's webinar, we're going to explore implications for equity valuations as negative operating leverage begins draining U.S. corporate profit margins. For those of you who subscribe to our research lab, you may have already seen the EPS growth and share buyback conundrum webinar recorded on September 22nd of 2022. For those of you who have not seen the webinar, it does a nice job illustrating how the concept of operating leverage coupled with share buybacks fueled EPS growth at U.S. corporations for years on end. In today's webinar, we're going to illustrate how negative operating leverage is now taking hold and unraveling profit margins at U.S. corporations. The September 22nd, 2022 webinar would be an excellent supplement to today's webinar if you have a few extra minutes. The following chart illustrates the relationship between the 10-2 Treasury yield spread and the U.S. federal funds target rate since June 1 of 1976. The bottom panel chart shows the U.S. federal funds target rate and illustrates the extent to which the Fed has engaged in the most aggressive rate hike campaign since the early 1980s. And you can see that increase here relative to other previous Fed rate hike cycles. The top panel chart shows the 10-2 Treasury yield spread currently sitting at negative 67 basis points. Please note that the horizontal blue line plotted at negative 50 basis points has been provided as a reference line for spread troughs reached prior to previous recessions. As you can see in the chart, the current spread level breaches the level of inversion seen prior to each of the four previous recessions to levels not seen since the early 1980s. Here's the same 10-2 Treasury yield spread chart blown up a little larger for you. You can see that from a macro perspective, the bond market is warning that a recession is on the horizon. The following chart shows the 10-year 3-month Treasury yield spread sitting at negative 117 basis points, and also illustrates the yield curve inversion recession cues remain at unprecedented levels below that 100 basis point horizontal blue reference line. As you can see in the chart, these current levels also breach the level of inversion seen prior to each of the four previous recessions and again represents levels not seen since the early 1980s. In a webinar I recorded back on October 6th of 2022 titled, "Is a Recession Priced into the S&P 500?" we determined that since January of 2022, the multiple contraction experienced by the S&P 500 can almost be exclusively attributed to the rise in interest rates. The same holds true from January of 2022 to today, with equity risk premium flat to down, meaning the risk premium investors require just to have exposure to the equity basket of securities has actually declined over this time period. We can conclude that the entire multiple contraction experienced from 2022 to date can be attributed to this rise in the 10-year Treasury yield. And in that webinar that we recorded on October 6th of last year, we actually go through the entire statistical analysis to show the goodness of fit of this relationship. It's pretty incredible. Look no further than previous recessions as a model for what happens to the relationship of the S&P 500 PE, the 10-year Treasury yield, and equity risk premium just prior to recessions. So you can see here, prior to the Great Recession, equity risk premium hit a trough before investors started requiring more of a premium just to have exposure to the equity basket of securities. And you can see that that led to a tremendous risk-off trade as investors fled into the 10-year treasuries, which ended up driving down the PE multiple for the S&P 500. You can see the same exact relationship here just prior to the COVID crisis. And you can see that right now we're actually sitting at that same low trough level. In fact, in regards to equity risk premium, we're literally sitting at 20-year lows now with a similar relationship forming on the 10-year treasury, but actually started that downtrend already. So what is the last straw for the equity market to begin pricing in a recession? The answer is it's the breakdown in the labor market. At Pacific Point, anytime we're questioning the ability of the labor market breakdown to trigger a recession, we mathematically transform the headline rate of unemployment to bring statistically significant explanatory power to the headline rate of unemployment. The following chart shows the year-over-year difference in the U3 unemployment rate and illustrates that a 1% year-over-year increase in unemployment has preceded each of the last 12 recessions back to 1949 with no false positives. And you can see that here, okay? This 1% increase literally preceding every single recession back to 1949. You can see in the chart as well that we're also rapidly approaching the inflection range between 0 and 1%, as evidenced by the black horizontal line. So you can see we're getting really close here. Recall that Fed officials and economists have estimated that the unemployment rate needs to rise to 4.6 or higher to bring inflation back to 2%. That's a full 1.1% higher than the current rate of 3.5, which would put us right about here. So what is the trigger for U.S. corporations to begin mass layoffs? The answer is negative operating leverage, a trend we have seen accelerating since Q1 of 2022. Let's take a deeper look at this. The following table shows the market-weighted S&P 500 income statement line items with associated quarterly year-over-year growth rates. Note the revenue line item is highlighted in blue. Older quarters with positive operating leverage are located to the right of the black vertical reference line, and more recent quarters with accelerating negative operating leverage are located to the left of the vertical reference line. Positive operating leverage can be observed where revenue growth in each quarter on a year-over-year basis is outpacing the increase in line item expenses. And we can see that here. I've got the year-over-year revenue growth rates quarterly outlined in green, showing that in all quarters relative to all line item expenses, the revenue growth itself is outpacing cost of goods sold, SG&A and R&D, as well as any increase in interest expense. Negative operating leverage can be observed where the growth in line item expenses are actually outpacing revenue growth. And you can see that here in all cases of cost of goods sold, SG&A and R&D, and interest expense. And you can see that those costs are accelerating and they're outpacing revenue growth, which is on the decline. So from a margin perspective, you have revenue growth rolling over and you have cost of goods sold line item expenses actually increasing. That's going to put compression on your gross margins. Couple that with SG&A and R&D, and obviously the increase in cost of goods sold and the rollover in revenue growth, along with associated other income statement items here, and you'll actually get a rollover in operating margin, which will actually show you some charts here in just a few minutes. And then this interest expense line item is very interesting. When you look at this, you've got tremendous increase in interest expense, which when you combine that with all other line items, then you get that rollover in net margins as well. At Pacific Point here, we're really curious as to what's going to happen here in Q4 of 2022 to see how these trends evolve. But you can see that these costs are accelerating at each line item at a time when revenue growth is in fact rolling over. With regard to labor costs, what we want to acknowledge is that cost of goods sold includes all costs directly related to the production of goods. And this obviously includes that large fixed direct labor cost component. Labor costs are also embedded in SG&A and R&D, and these are more indirect labor costs, okay? So when you take into account this negative operating leverage, this is what's really pressuring corporate profit margins to start rolling over. And this is what would ultimately be the trigger for U.S. corporations to begin mass layoffs. Again, relative to that interest expense on the increase, now posting quarterly year-over-year double-digit gains. This is despite long-term debt levels that have been basically flat to trending down. Okay, so this is a testament to how the rising interest rate environment is weighing on U.S. corporate fundamentals. As rates rise, variable rate debt gets more expensive immediately, and fixed rate debt gets more expensive if corporations need to refinance debt as it matures. We are now seeing this play out in earnest. The following chart illustrates that U.S. corporate profit margins began rolling over in 2022. You can see that here. They're doing their best to start their mean or median reversion, I should say, in this case. And while these margins continue to decline, they remain at the highest levels in over 22 years. You can see the S&P 500 gross margins at 32.9% relative to a 22-year median of 31.5%. The S&P 500 operating margins of 15.2% relative to a 22-year median of 13.4%, and S&P 500 net margins of 11.5% relative to a 22-year median of 9.4%. So clearly, to the extent U.S. corporations continue to hold out and the Fed continues to fight inflation, these profit margins are going to be continue to be under pressure. So in conclusion, equity markets and corporations alike are fighting the Fed, betting the Fed pauses rate hikes early or cuts rates prior to 2024 and does not force the hand of U.S. corporations to begin mass layoffs to ease labor market conditions. Again, the fact remains that as long as the Fed continues to battle inflation, profit margins are likely to continue to revert to 22-year median levels or even lower until corporations have no other alternative than to begin laying off employees to normalize their profit margins. Once this happens, you'll likely see equity risk premium begin to rise and the S&P 500 valuation to contract as pricing for recession begins to set in. That's about it for today's session. Thank you for attending and be sure to join us next time.